Welcome to Global Money Talk, brought to you by Sampro TV. Greetings to all of our viewers from across the United States, Korea, and around the world. We're coming to you live from the floor of the New York Stock Exchange in New York City, the financial capital of America. I'm your host, Tai Wong, and today I'm joined by Brian Violino, Vice President of Equity Research at Wedbush Securities.
Thanks for having me, Ty.
Brian,
Great to
thanks
be
for
here.
coming on the show. It's an exciting time in the markets, for real estate and mortgages. Could you talk a little bit about the overall state of the U.S. housing and mortgage markets? Certainly, we've had, I think people are a little bit disappointed in terms of mortgage rates went down, maybe within sight of 6%, and now they're practically at 7%. So just give us an idea of what the market looks like right now for mortgages and housing.
Sure, happy to. And yes, there was definitely a lot of optimism heading through the summer and into the early fall in terms of finally getting some reprieve on the mortgage rate front. We saw 30-year rates dip down close to 6%, which was the lowest we'd seen in a couple of years. That very quickly changed. Obviously, the 10-year has risen pretty dramatically back up into the mid-4 ranges where it's been holding for the last couple of weeks. The 30-year is tied pretty much directly to the 10-year with a spread, and so we've seen 30-year mortgage rates rise back up to to over 7% in some cases, and so that's really dampened a lot of the enthusiasm that we saw earlier over the summer. And then the other thing, that's sort of been an issue in the housing market for years now is affordability. We have a pretty significant mismatch in terms of supply and demand. Demand remains very strong on the single-family housing side, while supply remains well below the level needed for sort of a market equilibrium. And so we've seen home price appreciation continue, not as strong as we saw a couple of years ago, but home prices continue to rise, and that makes the affordability factor. When you combine that with the mortgage rates, much more difficult for home transactions to happen, refinance activity to happen. So we're in a bit of a lock-in phase right now in terms of the housing market.
It was very surprising for those of us who are, who learned economics, saying that high rates should bring lower prices in housing because of due to mortgages. But the fact seems to be that because the sellers can't buy a new house because rates are so high, they're not really selling those. There isn't supply going into the market. So do the sellers actually have to come first? If rates come down, do the sellers try to sell first, and a little bit of a delay in terms of how before the market really gets going again and houses become affordable? Can you just give us an idea of what that path may look like?
Sure, and the fact of the matter is that the majority of this country today, in terms of outstanding mortgages, that rate, over 50% have a rate below 5% today, and so to get the math to work in terms of somebody leaving their existing home and moving into a new home, we'd have to see a much more significant drop in rates, in our view, probably closer to that 5% range before we really start to see some of this transaction activity unlocking. And that's for existing homes. And the other piece of it is new home development. We haven't seen the amount of new home construction yet to fulfill the demand that's being seen. You talk about, the two generations that are starting to get into household formation, the millennials, Gen Z, both larger than some of the recent generations that have been buying homes. And so there's a lot of demand there and will be for years. And so we're probably going to have to see rates drop, something that's going to move the picture on the supply demand side. That could be higher unemployment, but we're not necessarily seeing that just yet, or new construction. And we haven't really seen, like I mentioned before, enough new construction. That could change going forward, but a lot of that comes down to local state zoning laws. And so the federal government doesn't necessarily have a whole lot of ways they can move that, besides incentivizing some of these local governments to open up zoning to build new housing.
I guess the big single home builders that sometimes we think about, the D.R. Hortons and the Toll Brothers, are the home builders, at capacity, or do they have the ability to really take a look at the market and say, there's a lot of demand, prices are high, no one's selling. Have they, or will they step in and try to create a bit more supply where they can, where they don't have to worry about the multifamily zoning laws and issues like that?
I think they're trying, and we don't follow the home builders directly, so don't have too much direct insight there. I know that there are rising costs obviously associated with home building materials, so that sort of limits their ability to build some of these new sites. There's also been higher financing costs over the last few years, so getting incremental capital into the home building space hasn't been the easiest. Um, you know, Long-term rates have moved higher, but we did see a bit of a dip in short-term rates. So, I guess there's some hope that we could see an increase in capital markets activity as it relates to the home builders raising more capital, getting more capital from bank partners if we do see the banks start to, lend more here. And so that could help the situation. But again, a lot of the open land out there is, still under zoning restriction laws, and that's really where the issue is. I think builders are ready to build. It's just getting over some of the regulatory hurdles.
I see. I see. Something you just said before was interesting. You said the mortgage rates need to maybe get down to around 5%, and if they're close to 7% now, it seems to suggest that the Fed would probably have to cut 150, maybe 200 basis points, and we're just not even sure that that's coming, or at least coming, certainly maybe not by the end of next year. So there might be a little bit of time to wait for that. I do want to ask you about mortgage credit and how mortgage credit is performing, and what are your expectations for mortgage credit going forward?
Yeah, that's one of the positive things coming out of the mortgage market today. And, we get asked questions by investors, are we approaching something similar to the great financial crisis? And in terms of credit, it's performing very strongly. We've seen, really strong underwriting standards since the financial crisis. Mortgage in terms of delinquencies and foreclosures, both those metrics remain low. They have moved up a bit in some of the first-time home buyer categories and some of the other Ginnie Mae categories, but by and large, the housing market from a credit perspective is pretty strong, and we generally expect that to continue going forward. Even if we were to see an uptick in unemployment, which is sort of the direct metric that would probably cause an increase in housing delinquencies and foreclosures, we still have all of this home price appreciation that's built up over the last couple of years. And so, what happened back during the financial crisis was we saw a pretty large glut of supply come onto the market. Home prices declined very rapidly, and there was a lot of homeowners that were left in what was called a negative equity position. And so, you had people doing strategic defaults, walking away from their homes, and that sort of exacerbated the problem. Today, given all the HPA we've seen, all the home price appreciation we've seen over the last few years, it would take a pretty significant decline in home prices before homeowners would start to go back into that negative equity position. So we do think that the housing market could hold up pretty well through even a mild recession, which again is not our base case scenario, but just because of all that equity in homes today, it should support home values for years to come. But that also exacerbates some of the affordability issues that we talked about earlier. So it's sort of a double-edged sword, if you will.
For our viewers, what single-family housing finance stocks do you see, are winners if long-term rates remain relatively elevated like they are now? Sort of the outlook between mortgage originators and mortgage servicers.
Yeah, so we're still focused in on the mortgage servicers, and our top three picks in that space today are Mr. Cooper, COOP, Penny Mac Financial, PFSI, and then Rhythm Capital, RITM. Those are the three names that we'd like here. Those names have had pretty decent runs over the last couple of years, and really it's because of their exposure to mortgage servicing rights. Those three companies are among the largest servicers in the country today. And for a quick background, a mortgage servicer is essentially performing the logistical measures that come with managing a loan once it's originated. And so it's an asset they hold on their balance sheet. They earn fee income off of it. And really the negative is when mortgage rates decline, because that's when people start to prepay their mortgage and the balance of that servicing portfolio runs off. And so they're earning less fees and the profitability goes lower. And so, it's one of the mortgage assets that actually performs better when rates are going higher, because you don't have that phenomenon of this amortization of the asset. And so we like mortgage servicing companies here. Those three are the largest that are publicly traded. And each of them has their own sort of niche components to it. Mr. Cooper is the largest mortgage servicer. They have a smaller origination arm, but they're really focused on recapture. So if we do see rates decline from where they are today, which again is a big if, it really depends on where some of this inflation data comes in. They believe they can go into that servicing portfolio and recapture that as a new loan, a new refinance loan, and put it right back into the servicing portfolio. Um, Similar story with Penny Mac. They have a slightly smaller servicing portfolio, but they are able to, ideally recapture a lot of those loans. They also have a much larger origination arm, and so they're able to go out into the purchase market if we do see a rebound in the purchase market, but also benefit from servicing if rates do stay higher. And then the last one, Rhythm. Uh, about half their book value is related to their new res division, which is the company specifically focused on the housing market and mortgage. And so again, large servicing portfolio, similar sort of dynamics. They're also getting involved into the asset management space, so this is a bit of a different spin. They traded a discount to the other two companies, but they recently acquired a company called Sculptor, which has significant AUM and is growing, and so they're looking to branch out into the alternative asset management space while also having this housing division and component to their business. And so three different companies that are more exposed to mortgage servicing, which does well in higher rate environments, and so it should do well, if rates stay higher for longer.
That's a really great insight. I guess those of us who have a home deal with these mortgage servicers. And let's bring up graphic two. I just prepared a chart of Mr. Cooper, so our viewers can see. And you have you have research on it, and I think it's currently trading at around $97 a share, and your 1 year target is around 115, if I got that correct. What's really interesting is actually I own a small investment property, and my servicer just transferred from Flagstar to Mr. Cooper, and when we saw it, it was like, Mr. Cooper? What's Mr. Cooper? It just seemed like it's a name that honestly I hadn't heard before. So I was really kind of gratified when I saw that you actually follow it and you liked it, because we're like, is this some like terrible fly-by-night outfits that's servicing my mortgage? So I guess a question for them is, how do you, the mortgage servicing portfolio, how do these folks really, do they make money on volume? Because is there a lot of sort of wiggle room in how much they can charge servicing fees?
Yeah, it's a great question. And you did touch on Flagstar, which is something I had forgotten to mention earlier. They did recently acquire a large component of the Flagstar servicing portfolio. They just closed on that fairly recently, and so that's another component to the story that we think is helpful, and it sort of plays on the overall servicing business strategy. And it really is a business that is very reliant on operating leverage and scale. And so Mr. Cooper, it's not necessarily a household name, but they are the largest mortgage servicer in the country. Over $1 trillion of UPB in mortgages they're servicing as of today, and that's expected to grow over time. And they've done that organically and inorganically. But essentially, yes, the mortgage servicer will take a cut of the fee. It varies, but it's usually 25 to 40 basis points before that mortgage is passed along to the mortgage-backed security. And so they're just similar to Fannie and Freddie, who takes a guarantee fee. The mortgage servicer will take their cut for performing their duties in terms of passing along the insurance and escrow, managing any delinquencies, coming up with potential forbearance plans. And so that's what they're getting compensated for. But as you grow that servicing portfolio, and this is something that Coop is really focused on, you can really pull a lot of operating leverage out of that business. You don't necessarily need to hire a significant significant increase in staff in order to handle, a few million more in mortgages, right? And so that's really how you grow, the business is scaling. And that's, especially scaling in a higher rate environment, because you're not getting the offset from these mortgages prepaying. And so that's sort of the ideal operating environment for a mortgage servicing asset. If we're not even talking about sort of the recapture possibilities that we talked about before.
Well, I have to say that in my experience, it actually went rather smoothly. They said, we're going to be taking over your mortgage. We're going to take your money a little late this month, but everything was fine. And actually, it went very smoothly. the last time somebody switched servicers on me, I actually had to go and totally renew it, put all my information back in, and so it would withdraw every year. And now I just want to, every month I should say, and now I just want to make sure they pay my taxes and all my taxes and my insurance. And if that if that's it, then if that's smooth, then actually be really good. But it was just quite a surprise because I just never obviously had heard the name. In terms of I guess these servicers, I guess the banks or the originators really don't have the ability to scale that. So it really comes down to these guys who are really specialists, is what I think I'm hearing.
Yeah, and it's a good question because if you go back 10, 20 years ago, the banks, some of the money center banks, the regional banks, were the largest mortgage servicers out there. And so what we saw after the financial crisis, clearly, there was a lot of pressure on the banks to divest from the mortgage industry. There's been a pretty significant shift in terms of mortgage assets moving out of the banking sector and into the non-bank sector, which is where my coverage is focused. And that's continuing through till today. Wells Fargo has, gotten rid of a large portion of their mortgage servicing portfolio. They've exited some of the mortgage origination channels that they were in, and Coop, PFSI, Rhythm, and some of the other origination-focused companies like Rocket Mortgage, United Wholesale Mortgage, also companies we cover, have taken a lot of that share. And so it's really moved out of the banking sector. The Basel III endgame rules, which are sort of up in the air in terms of how punitive they will be from a mortgage perspective, those would have made it even tougher for banks to hold on to mortgage servicing rights. I think banks like the idea of them because they're a great sort of relationship tool, especially with some being a touch point with their clients and being able to cross-sell product. But it was just getting so sort of punitive from a capital perspective that the banks kind of gave up on the asset. And that's why you see a lot of the mortgage servicing being performed today by non-banks. And we expect that to continue, over the next few years, barring some sort of massive regulatory change.
You mentioned that I think Mr. Cooper and was it Penny Mac, they also have sort of origination arms. I guess that makes a lot of sense because if some of these prepay, you have to get new loans on board so you can benefit from that scaling. Is there will there be any mergers or acquisitions in the market where maybe you'll get a little more combinations between or matchups between these servicers and these originators? Seems to be would be a pretty good marriage in a way.
Yeah, it's a great question. We had been expecting to see mortgage consolidation for a couple of years now, especially when rates started to first move up. We haven't really seen it, kind of surprisingly, in mass. I talked about the Flagstar acquisition, which wasn't a whole company acquisition, but they bought a large chunk of the servicing portfolio, and they also got Flagstar's third-party mortgage origination arm, so they got their correspondent and their wholesale lending business. But in general, we haven't really seen that mass consolidation. Could it still come if rates stay are for longer? Possibly. I think instead of seeing two of the larger mortgage companies come together in sort of a merger of equals, we're probably more likely to see consolidation of their smaller mortgage players that are non-public being sort of bought up by these larger players, or just falling by the wayside. It's difficult for smaller mortgage companies to operate in this sort of environment. They don't have the resources that the large public players have. And so, we could see consolidation, or these companies might just sort of fall by the wayside. And we just see increasing scale and consolidation in terms of market share growth by the bigger players just by attrition alone. They won't even have to pay up for the acquisitions. But, there could be some deals here and there. It's just not necessarily something that, I think if we've gotten to this point and we haven't really seen it yet, not something that we're going to see, going forward again, unless rates go even higher.
So let's switch gears a little bit and get to a topic that a lot of people are interested in, but I think folks don't know much about other than what they read in the headlines in the papers, and they're usually not, not as deep as we'd like them to be. So the commercial real estate market. How is the state of the commercial real estate market? This volatility in rates that we spoke about earlier, how have they impacted sort of transaction activity? And are we near the bottom of this the commercial real estate issues, or do we have further to go?
Good question. And we follow a few of the players in the commercial real estate space, Walker and Dunlop, Arbor, some of the big agency multifamily lenders. Also, Ready Capital is involved in the multifamily space. And, what we heard interestingly during earnings, over the past couple of weeks was that there really seems to be hope that there's an inflection point happening in the commercial real estate market today. And that's with a lot of the volatility that we've seen going on in the background. Um, so, I think everyone in commercial real estate would be happy to see rates go down, but even more importantly, stabilization in rates, because the way these real estate transactions are sort of constructed is based on longer term yields, and so the 5 year, the 10 year, these are all very key benchmarks for these investors and these companies that are providing financing for these deals, and so I think we saw definitely an increase in transaction activity in the third quarter. That's probably tapered down a bit as we've gone into the fourth quarter, just again because of that volatility. But if we do see rates stay, sort of flattish in the mid fours, and I'm talking about the 10-year Treasury, I do think we could see a pickup in transaction volume going into next year, just purely because stability will give cap rates time to adjust themselves, and investors can sort of plan out borrowing costs versus the income of the building, especially on the multifamily side. And so I think that's really what the key focus will be on in terms of transaction activity for commercial real estate, is seeing some sort of stability in rates, even if it's a bit higher than they'd like. I do think that would be an incremental positive. On the credit front, we have seen delinquencies continue to move higher in CMBS, for instance. Fannie and Freddie are reporting, sort of modestly higher delinquencies here. And so that's going to be an ongoing story. I think that that's a lot of that's, especially on the CMBS side, is really still being driven by office. That, of course, has the work from home phenomenon that I don't, necessarily think is going to go away anytime soon. And so that cash flow issue still exists for office. On multifamily, the fundamentals are actually, pretty good. Vacancy rates remain pretty high. Rents are, sort of modest right now in terms of rent growth, but the buildings are able to operate. It's just more of a rate issue. And so what we're seeing now is a lot more of modification activity, extension activity by lenders, by banks who are involved in the multifamily segment. So, we're not seeing real significant losses in terms of those assets just yet. They're just being extended at, below market rates to, keep them going, in hopes that we see a drop in rates and they can be refinanced at a, more favorable rate.
So from what you just said, it seems like probably the worst outcome would be high and volatile rates, where they can't refinance, and the benchmarks are an issue and the rates aren't setting. So high and volatile seems to be, I guess, the sector's worst enemy.
Yeah, which we're kind of seeing right now. And so, a lot of that optimism in the third quarter, I think, was companies talking specifically about things they're hearing from their clients. And, there was some uncertainty around the election at that time too. So, I think there's some hopes that post-election, clients are sort of know what's happening from a political front, and they could get a little bit more comfortable about taking a long-term bet on commercial real estate. But yeah, elevated and volatile is not a good friend to the commercial real estate market in terms of getting transactions done.
Is the sort of, you just mentioned that some of the non-performing issues are still sort of growing. Is there sort of an end in sight, or does that really rely on lower and perhaps stable rates, where the industry can sort of get its get its affairs in order? Is that really the solution, lower and more stable rates?
I think it is. The extension and modification activity is going to continue. But you also have to, measure that against the company's funding costs, right? So if you look at a bank, if you look at a non-bank lender that uses bank financing, a lot of those, that funding cost is tied to short-term rates. And so obviously we've seen the Fed cut a couple times now. That's benefiting them on the funding side. And so that gives them a little more incremental ability to extend these loans and not, take a hit on their income, because their funding costs have seen some relief. And so I think, we'll see how the short-term rates play out. No guarantee that we still see all the cuts that were being priced in a few months ago, but that's helping them a little bit. But in terms of actually getting the loans themselves refinanced or put into permanent financing, yeah, I do think we need to see rates drop from here and stabilize. And the number we've heard thrown out by a few of the management teams is 4% on the 10 year is really sort of a key focal point, where there seems to be a lot more demand to get financing done under that level. It's easier to get incremental capital injected below that level, and above that is when it gets trickier. And so that's a key level that we watched out for. We definitely saw the demand picked up when it briefly dropped below that for, a few weeks. And it's likely slowed since then, but that's the key benchmark is 4% on the 10-year that we look out for.
So if for the individual investor, the sophisticated individual investor, if they wanted to get involved in commercial real estate, in the commercial real estate market in terms of investing, is there a good way to do it? Is it through some kind of REIT, or is there a commercial real estate ETF?
I'm not entirely sure if there's an ETF. I'm sure there's CRE related ETFs out there that I may not be aware of. But, we follow a couple of sort of key players in the space. A lot of the commercial real estate is, being held within mortgage REIT type vehicles. So for instance, we follow a company called Arbor that, does a lot of bridge lending. And so that's based on sort of short-term floating rate financing. We also cover a company called Walker and Dunlop, which is very focused on setting up agency financing. So they work with Fannie and Freddie to get multifamily loans done. And so then there's also the banks that, have pulled back a bit from lending into CRE because of given all sort of the hair on it today. But they still carry a lot of the financing today. And so there's a few different pockets where you can invest in commercial real estate. We are on the sidelines in terms of our ratings for the couple companies I mentioned, Arbor and Walker Dunlop. The stocks have sort of traded sideways. I think we're looking for a bit more clarity in terms of when we could really see a rebound. It seems to have gotten pushed out a couple times now throughout the year. And so we're not ready to jump into those stocks just yet, but something to keep a lookout on if we do really see, a reversal in these trends in terms of rates going back down, that there's probably some upside to be found there. We're just not there quite yet, from an investing perspective.
Oh, definitely keep an eye on those. And before we go, I do want to talk to you about Freddie and Fannie. They've been in conservatorship, and do you think they'll potentially exit sometime during this upcoming Trump administration? And if they did, what would the impact of that be, and the impact of that on the housing market as a whole?
Yeah, so this is definitely something that's been a hot topic amongst investors that we're talking to today. Both of the common shares of Fannie and Freddie have really skyrocketed after the election, up significantly. We are a bit more hesitant to think that a potential recap and release is going to result in some massive value for the common shareholders, and I can get to that in a second. But in terms of the impact on the housing market, clearly the Trump administration had put through some measures in his first term to try to break the companies out of conservatorship. Never really came to fruition. But there's now sort of this renewed faith that this is going to happen again this time. I think, it's definitely possible. I don't think it's something that's going to happen within the first couple of years. We're hearing 2027 thrown around as a potential time frame for when this could happen. But what, kind of gives us hesitation for saying it's a definite sure thing is some of the residual impacts that we think could happen to the housing market. Fannie and Freddie are, since conservatorship, are sovereign credits. They have the full faith and backing of the U.S. government, and so their credit rating reflects that. And that gets passed along to all the securities that they produce and that are bought up by banks and, previously the Fed and foreign governments. And so, I think the fear is that if they get removed and there's some jitters in the market and they don't get that sovereign credit rating anymore, what does that mean for all the product they're putting out? They're guaranteeing 50% of the U.S. housing market today. And so, I think that some of the residual impact could be you see, higher spreads on mortgage-backed securities that they produce. That could change the risk weighting that banks will have to use when they buy these securities, which could lower demand. And all of that could lead to higher mortgage rates than we have today, which obviously I don't think is the goal of anyone from a political perspective. And so those are some of the things that I think could happen. Again, there's no guarantee that this even occurs, but those are some potential risks that happen. If they're brought out of conservatorship and the market doesn't really like how it's done. As it relates to the companies themselves, like I mentioned, the common shares and the preferred shares of both have really climbed under the anticipation that there will be some sort of release from conservatorship, because they are very profitable companies when you look at them. It's just the way the Treasury's preferred shares are structured. every time the company earns money every quarter, it increases the liquidation preference of the Treasury's preferred. And so, they're undercapitalized today. They have this growing preferred share that they, essentially is taxpayer money that they have to address. Some are saying they may not address it, some are saying they may. But, in our view, there's really this big capital hole. And so, we're talking about hundreds of billions of dollars in terms of equity capital that, as the rules stand today, they would need to raise essentially to get out of conservatorship. But again, the rules can change. And so we think raising that amount of money, which again is larger than any IPO we've seen, would be pretty dilutive to the common shareholders. And there's different ways they could go about that. But so we don't really see a lot of value in the common shares because it's sort of a lose-lose in either of those scenarios. But preferred shares, that's where if there is some value ascribed to the common equity, there should be some value ascribed to the preferred shares given where they sit in the capital stack, and you don't have the dilution issue. So if we were going to look for an area where there's potential, upside value in Fannie Mae and Freddie Mac, would be in the preferred shares versus the common.
Great. Well, that was a really, really great summation. Sort of like training, you have to take the training wheels off the bike if they're going to go independent again, very, very slowly and carefully. Well, Brian, thank you so much for coming on the show. And look forward to talking to you again sometime soon. And that will do it for Global Money Talk, live from the New York Stock Exchange. We're so excited to bring you daily coverage here on Sompro TV. You can check out the show anytime on our YouTube channel by searching Global Money Talk. Thanks so much for joining us. We'll be back here tomorrow. Have a great day.